it's interesting, right? We'll start with the central bank discussion. It seems like the last couple of days, I think barring yesterday, you're seeing weaker macroeconomic data coming out from the U.S. And the markets really did kind of see a bit of reset, especially in the bond market in some ways. Do you think that in this environment, are we basically past peak Goldilocks now in the U.S.?
Yeah, well, good morning, Yvonne. Morning, David. It's a great question to start the discussion because you're quite right. There is a cooling off of the growth trends. We see it in the job openings data, in the payrolls data, that broad reading of all of the different signals that we get, gradual cooling off really coming through. And we've seen the same kind of signals playing out on the inflation side as well. So the mood today among the range of economic indicators is a little bit different to what we saw in April, the height of those inflation worries, the height of the no landing set of thinking among market participants. And like you say, that shift is having a big bearing on the outlook for policy, the outlook for the stock market as we look into the second half of the year, and the scenario for treasuries and the broad global bond markets too. We've seen a big reset around market rate expectations this year. Remember, we started the year at 7 cuts. Yeah. Quite remarkable. So 1 to 2, depending on which day of the week you look at the market. I think that puts the Treasury market, the short-term Fed funds futures curve on a more sort of normal footing. It's not obviously wrong. There's more symmetrical risk to that scenario. Fed could go a little bit more. It's possible. Or we could see maybe fewer cuts being delivered. But it looks more balanced. And, of course, that sets up, I think, then a better situation for core government bonds, for core treasuries, for gilts, for the European bond markets going into the second half of the year. It's been a difficult start for government bonds, but the second half of the year might be a little bit better as a consequence.
Right. So do you suspect then bonds might relatively outperform equity markets, which have done well? Is the path clear for bonds at this point, given what you just outlined there?
Yeah, so I think the advantages or the investment case for owning core government bonds at this point is based around the yield levels, which seem to be attractive amid restrictive policy. Yeah. The all-in yield, exactly, as you say. The situation that we might see continued disinflation, I think that's probably right. Okay. I mean, it's been tricky to read the picture, of course, because we've had sticky inflation and some specific factors going on in rent and other services components in the US inflation in particular. But our assessment is that inflation has been sticky, but it's not stuck. And so if that plays out and proceeds as we go through the second half of the year, then the combination of the policy pivot, good starting yields, and disinflation trends, I think put treasuries, core government bonds in a better situation from a return perspective. So a return for fixed income in the second half of the year looks good.
So how are you looking? Are you reducing your exposure to equities now in general, or do you think this AI trade can actually keep things afloat for now?
Well, I mean, as you said on your introduction, the AI theme is unstoppable. The Magnificent Seven theme is unstoppable, at least for now. The question for investors and our own fund managers is really assessing the extent to which the expectations have now moved so far ahead of what is deliverable in the near term that it could create a little bit of a air pocket. And if you think about the valuation position of the Magnificent Seven, more than 30 times earnings compared to the 18 times for the broad S&P 500, and also the fact that we've seen such strong profits growth, which means that sequential growth, as we look into Q3, Q4, the second half of the year, that becomes a little bit harder. The hurdle, the relative hurdles are that little bit higher. So we suspect that what we're going to see actually is a broadening out of market performance into other sectors, laggard sectors, maybe some of the more defensive or left behind cyclical parts of the market. That's not to say that the AI story is over. That's not to say I'm not an optimist on the productivity benefits for social welfare and economic outlook. But I worry that a lot is already priced in. Yeah. And we might see not just some of the other sectors in the US begin to catch up a little bit as the market broadens out, but also other parts of international equities, Europe even, Japan we continue to like as a market, and of course the Asia region continues to offer superior growth at good valuations, especially if the Fed does finally pivot.
Finally, I was going to ask you actually about Europe. Yeah. Markets there have done well as well. Yeah. Even the FTSE, of course, over in London. Your outlook for that part of the world?
Well, I mean, the situation in European stock markets looks okay, actually. We've had mid-single-digit returns so far
which is strange.
This year.
You don't normally see this group do that well.
It's something to be celebrated, right? Europe is life in the slow lane. So we take that a positive return with all of the positives that it implies. Look, the reality is we're seeing better economic momentum and better profits momentum in Europe. And expectations were set at such a level that it was possible that you could get a positive surprise. So when analysts are only expecting 4 or 5% earnings growth going into 2024, and we're ending up with maybe mid-single-digit profits growth over the full course of the year, that's an important positive to celebrate. The momentum is there in terms of the economic story, and the valuation discount remains pretty significant. So Europe trades maybe about double the discount versus the US to what we typically see. Yeah. The PEs are much lower than the historic norms. So there is a valuation anomaly, a valuation opportunity in European stocks. And if the ECB is cutting rates, like you suggest, I think that's probably right. We probably see maybe the ECB proceeding at one cut every quarter, that sort of cadence. That is a boost not just to the European stock market, but to European small caps as well. I think you've got to be careful of the politics.
Yeah.
And of course, as you say, the extent to which the ECB can untether itself from the Fed, or economic momentum in Europe can untether itself from global economic trends or US economic trends is an important variable to watch. But the situation in European stock markets is looking much more optimistic than it has done for a little while.